So welcome to a new episode of The Raw Take by GrowthLab, a leader in the finance as a service ecosystem. And here on The Raw Take, we share how we help our customers address their current challenges, their risks, and opportunities to drive value. And this is hosted by me, Dan Gertrudes.
And me, Stephen Byler. Our goal each week on The Raw Take is to leverage our experience, our journey, to help you scale your business. Here we go.
All right. Good afternoon, everyone.
It is November 4th.
November 4th.
Here on The Raw Take for CEOs. Welcome back.
Yeah, welcome back. Coming down to the stretch. I feel like the holidays are right around the corner.
I think it's going to wrap up in the next 2 months. The year's going to wrap up. Kids' activities are going to wrap up.
You literally have to wrap up because I think if you wait beyond this week or next week to try to buy that gift, that electronic, that toy for your kid, like, I don't think the kids aren't going to have shit under the tree.
We were just having this conversation. My wife's coaching a robotics team.
God bless her.
And or two teams actually, but one of the teams, the kids are like extremely nervous about receiving their gifts on time.
Because they're not, because there won't be any gifts.
So some have been waiting for a Christmas gift from last year that hasn't showed up yet.
There's not enough truck drivers to actually get the gifts to the kids.
It's crazy.
Anyways, another episode of The Raw Take for CEOs. It is the first week of November. We're actually trying to plan our holiday party for next week. I'm looking forward to that. And coming into the stretch of the year, we're starting to have conversations across the board with bankers. It was a good year overall, considering last year. Obviously, when the baseline is in the crapper, anything above that looks great. But even when you compare this year to, say, 2019 for many industries, you can't complain. I don't think we can complain about our business. We've done pretty well. We grew 35% year over year so far, and we had our best month ever in October. And we're seeing that with many of our customers. But on the flip side, what you're seeing is inflation taking a chunk of your revenue. And what you could bank on for 60, 65% gross margins are looking more like 45, 50% gross margins. I will tell you, like in our business,
especially in the manufacturing space, right?
Especially in manufacturing, hospitality.
Right now, that's where it's taking the brunt of the increase in prices, supply chain issues, and having yet to be able to pass a lot of that on to the buyer, right?
Yeah, and even in the service-based business, I think, I don't know, I look back Q1, Q2 of this year, we saw the risk of people not coming back to work. We saw the risk of not hiring, not wanting to hire, whether that's a demand or supply. And, we built out the team probably to a point where I had a few sleepless nights back in May, April, sort of scratching our head like, we talk about building the factory all the time, but yet did we overbuild, right? Mm-hmm. And when you're seeing certain divisions in the company's gross margins hitting the low 40s, you're sort of having a little bit of a no shit moment. But with that said, I don't think there were already signs. We could see signs, not just in our business, but in our customers' businesses, having a difficult time, not just getting supplies, raw materials, but actually labor. So you go back to the beginning, sort of springtime, whether you're in the hospitality industry trying to rehire for the big wave, or in manufacturing trying to get to meet your customer needs, customer demands. And so you need more people, you need labor. Mm-hmm. They're already, the signs were already there. People were sort of like, I got COVID, or I'm taking care of a COVID person. I can't go to work. My kid's not in school. I can't go to work. So what we're seeing right now with the whole great resignation, like we talk about for the last few weeks, we've been talking about it here. We've been talking about it in newsletters and emails and meetings with customers and bankers. It's amazing how many responses I actually get to those emails and those newsletters. This was from a newsletter last week. I had one guy today. His first comment was, I don't know how I got on your list. His second sentence was, I totally agree with you. This is for real, but it's only for real if you allow it to take control of your business. I believe he was responding to, here are 3 hedges that you could take to offset this risk. It's true. So we were fortunate enough. We built the factory,
Took the hit on gross margins.
took the hit on gross margins, but we were in a position in Q3 and into Q4 to actually meet the 35% increase in demand for our services. So I don't know, I'm not patting myself on the back, but I'm sort of saying sometimes you got to take front-loaded risks to capture opportunities further down.
And it all goes back to planning, which we are obviously huge fans of. And planning, build that factory before you have the demand, right? That's a planning thing. Then we invested in marketing, we invested in sales to feed that beast, and now we're seeing that come to fruition.
Yeah, no, 100%. And so in terms of headlines this week, it's not like there isn't major economic news out, except it's the same lingering shit from like last week, the week before. Inflation, is it for real? Is it not for real? Here, a quote from Fed Chairman Jerome Powell: "We don't think it's time yet to raise interest rates. There's still ground to cover to reach maximum employment, both in terms of employment and in terms of participation." There are 2 parts to that. One, yes, inflation is for real. Policymakers, feds, probably don't feel like the threat of higher inflation is a lingering threat. They feel like it's a one-off based on 2020 numbers. I guess if you reflect back to 2019 and what that looks like, maybe it's not as dramatic, but it's really that last phrase in that quote, which is terms of participation. And if there's anything holding back this economy, and there's anything that's holding back small businesses and even venture-backed startups, it's going to be their inability to attract people who are not actually participating in the labor force right now.
Right.
And that's scary. And it takes a different type of HR, people management, people acquisition strategy. It's more hands-on. We just recently hired a young man to be one of our first SDRs. So that's sales development reps for our RevOps team. We have a BDR, but we really needed more capacity and better capability. And we've actually been looking for this position for maybe 2 months, 3 months, but it was a very passive search, right? It was not an active search until last week. We found this individual and then was able to connect the dots with this individual. And it just happened to be this individual was in the process of figuring things out. And he signed 2 days ago. If there was a 4th hedge on last week's newsletter, it is, if you want to attract talent, you got to make it intentional. It can't be this passive shit, right? It can't be like, you can't just talk about it. You can't just post it on Indeed. You can't just post it on LinkedIn. You got to find people the same way you find customers.
You got to recruit, like be your own recruiter. Like go out there and find these people. Don't wait for them to find you.
100%. Again, I go back to labor participation. That's the scary number, and inflation. So the second quote I want to bring up is, this is the chief executive officer from the company that owns Oreos, right? And it has all to do with inflation. And I just got out of a banker's meeting today. Yeah. And our customer, they've already raised prices once to offset raw materials, to offset transportation. Do you realize like the transportation or trucking industry actually is estimating that the industry needs another 80,000 truck drivers? 80,000. Wow. Where the hell are you going to find 80,000? Your kids aren't getting Christmas presents. And so the CEO of the Oreo, parent company of the Oreo, he said, we've been increasing prices, and we plan to increase prices more than we've done, at least in the time that I've been here, and probably for quite a while as a company. Like, they're not just passing inflation and costs on once or twice.
They have to do it multiple times.
This is gonna be multiple times. And the banker that was actually on the call with us this morning, and the customer, he said the same thing.
Yeah.
He said, one price increase just isn't enough.
If it isn't for raw materials on the services side, you're seeing a labor participation issue. You have to pay people a lot more today than you did 6 months ago. You got to pay them a lot more. We've seen that in our customers, and I think that's going to trickle down. Go through planning season here. Come March, April, when you're doing reviews and raises, you need to retain those people. You need to keep them at the table. It's a lot cheaper than attracting, retaining new talent.
Yeah, so you can sit here and do nothing. We can sit here and talk about inflation and talk about the Great Resignation. But what are 3 things that businesses can start doing today to mitigate the risk of inflation, mitigate the risk of people? I think like making people, both retention and acquisition of people, especially for software companies, venture-backed companies, high-tech companies, service-based companies. I mean, come on, let's face it, like 50% of your revenue goes to people. And if you're a cash-burning startup, which is the theme of today, not the burning, but the actual startup, easily 80% of your cash burn on a monthly basis goes to people.
Oh, yeah.
Easily.
It's
so
biggest
that
spend.
And making that retention and acquisition intentional.
Yeah, I think what can we do? I would focus on the softer side of things, like your compensation to them is your compensation to them, and that's a big factor that keeps them at the table. What really will retain them is whether it's professional development, whether it's that sense of purpose, that sense of like ownership, whether literal or figurative. Especially young people these days want to be able to see that their input, not their decisions necessarily, but their input is kind of driving the bus.
It's connected to the big why of the company, the vision. And it's funny you mentioned the word purpose, because this gentleman that responded to my newsletter email, he used the word purpose. He said, young people want purpose. And if you have people with purpose, none of this really will affect you. None of this will really matter. And I think there's some truth to that.
Yeah. No, there's a lot of work that goes into that to make the people feel that they are part of something that is giving them purpose.
Yeah, and again, like back to the economy and how does it impact small, medium-sized businesses? It's a double-edged sword right now. You've got consumer demand, like the Roaring 20s, just happened to be in 2020s, right? The Roaring 20s type of consumer demand, but yet you don't have the people to produce. It's difficult to get your hands on the supplies, the raw materials, and then to boot, inflation is really eating at your gross margins. It's just like, what do you do? And if you don't have a whole lot of elasticity in your price, you're almost like where we were 18 months ago. Like, do you transition? Do you pivot, reinvent? Do you adjust? Like, what do you do in this situation?
Mm-hmm.
And that's something we're going to be talking more about in the coming weeks.
November financing month. Today we're going to talk about startups. The next few weeks we'll talk about revenue financing. We'll talk about bank financing. We'll talk about restructuring and some of the experiences that we've had and some of the insight that we've had. But today I want to focus in the startup world, because there's some news coming out of Q3 that is just pretty impressive in terms of the venture world and all the money that's flowing into startups and flowing into new funds too.
Of course, with the end of Q3, a month out, a lot of the regulatory filings are coming out. And I read an article about university endowment. And it's like impressive, never mind like the return on investment or the return on the fund over a 12-month period. But the amount of liquidity they're actually sitting on that was originally generated from startups, venture-backed startups that ultimately went, that IPO'd.
Sure.
And it's amazing, like the numbers that are being thrown around right now.
Because a lot of universities do have that transfer, technology transfer, whatever they call it, in their space, to capture a piece of the pie of the stuff that's developed at the university and licensed out into usually into startups.
All right, so November we're talking about financing, and today we're going to focus a little bit more on startups. And so I think about 75% of our customer base is in one way or another a startup meaning venture backed, family and friends, seed. We're not talking specifically lifestyle businesses or other entrepreneurs that may have started non-scalable businesses, right? So when we talk about startups, we're really thinking about the seed, the series A, etc.
Yeah, and the the mindset is that growth mindset, right? I'm not in this just to build a lifestyle business. I'm in this to, whether I need venture money, whether I need friends and family, I'm in this to grow the business. But on the venture side, Q3 was globally a record quarter. Over 100% growth compared to 2020, and most benchmarks compared to 2020 are going to be like, oh yeah, of course it's going to be 100% growth. But 2020 in of itself, we never saw a dip in venture, seed. All that pretty much either seed kind of stayed flat across 2020.
It was a blip on the radar.
It was a blip on the radar, but others,
April.
Q2, 3, 4, they kept ticking up because there was plenty of liquidity, and venture firms were finding companies that were really solving problems or developing new ways of doing things to put that money. So overall, as we compare these numbers to 2020 in of itself was an up year in venture. So when we're looking at Q3 2021 being 105% globally of growth over Q3 2020, it's impressive numbers. We get almost $160 billion of venture money deployed globally. Q3 2021, and about half of that was in North America. So North America was not a record quarter, but it was close to it. The last few quarters here in the Americas have been around 80 billion and venture funding. So it's been active. 2021 has been a tremendous year. We're seeing it at our customers. They're just out there raising money.
Yeah, I'm telling you, one of the things the U.S. government should have done with the PPP loans is any PPP money that went to startups that had venture funding, the U.S. government should have taken a piece of the action. Saying that publicly.
Next policy statement, Governor Gertrude will have to say. It was an impressive quarter. A lot of that growth came from like the Series A, Series B. Like I was saying, the stats, and a lot of this is coming from Crunchbase, others that are putting out kind of their reports. Seed funding was rather flat, but early stage A, B funding took a big piece of that growth quarter over quarter.
So we have a lot of customers that come to us, a lot of market leads come to us and say, hey, I've raised a family and friends round, a pre-seed round, trying to position the company to raise additional capital.
Mm-hmm.
What's the first thing you tell a company that is looking to raise capital?
Yeah, I think we've even seen more people kind of come out of the woodwork, and they have been planning to just kind of continue the business. And now they're like, let's raise money, right? There's a lot of money out there. Let's move from a LLC to a C corp and raise a small venture.
So this is our opportunity to speak to many, right? Because we have been taking more of these phone calls, 20, 30 minutes. It's like, hey, I want to raise money. And it's like, okay, here's what you need to do. Come back to me, right? So what do I need to do before I come back to you?
Know your plan, right? And that's half the battle that we work with customers is to build. What does your liquidity profile need, right? You can't just say I need some money to throw into marketing, or I need some money to hire some developers to build the product, or I need some money to X, Y, and Z, right? You need to know how much money you need, when you need it, and what you're going to use it for. That's your liquidity profile. So that really is like kind of getting up to bat.
And so how much money do I know? How do I know what I need?
So you got to go through the process of like, what do you want to do, right? What are your main goals? Do you want to double revenue? Do you want to get to an MVP? Do you want to, you fill in the blank? You put your goals together, and then you build your plan to meet that. If you're going to double revenue, how are you going to do that? What's your business model? Know your business, know your pricing, know how you're going to get there, and then you need to support that revenue or support that development plan.
So let's take it down a notch. What is a plan? Like, what do I do? Is it back of the envelope? Is it on a napkin? Like, what is that plan?
Yeah, it's a good question.
What are the components of that plan?
I would say it starts with the back of the envelope, because you need to bring everybody to the table, whether that's founders, co-founders, whole team, whether that's your board. Here's what we want to do, and that is a little more, I'll say, back of the envelope, right? Set your goals. Let's say double revenue. Don't go to the market to raise money with that back of the envelope, right? You need to build a model that gives you that from the ground up how you get there. So if you're going to get double revenue and your customer acquisition cost, is $100 per customer, and what's your average price point? How are you going to get enough customers? Where are they going to come from? You need to spend marketing dollars, need to hire sales team, need to make sure that the service delivery team or the product can support it, so that you're not churning at a higher rate than you're bringing customers on. Yes, it starts out like kind of large picture, where do we want to go? But then it's got to get down to the details, because if you don't get there, investors are going to tear your plan apart.
And when you say details, we're not talking details to the nth degree.
So I don't like when I get a model, or I've even built models this way, and we kick ourselves in the foot when we get too detailed, right, Dan? It's not, here's how much I'm going to spend on this vendor and that vendor. It is where you spend most of, call it 80% of the time, is on your revenue and your cost of goods. Getting into detail there, what does the customer journey look like, and so that you have the resources around the table. Don't spend the time on the 20% that's not going to move the needle. If you spend $100 or $150 per head on SaaS stuff just to enable them to work, like Gmail, and don't put those as line items. Just put $200 per head per month and call it a day.
And so at the end of the day, we're looking for revenue minus cost of goods sold, which is your gross profit, and then building out of the business, which is essentially your OpEx. And at the end of the day, for most businesses, A minus B equals C, C minus D pretty much equals your free cash flow.
Yeah.
Right. And so then that free cash flow is, over the next 2 or 3 years, tends to be negative. And so with a negative, you need to backfill with outside capital.
Yeah.
At very high level, simplistic here, that's how it all works.
Yeah.
And what's important is to be able to understand the drivers of each of those components: revenue, cost of goods sold, gross profit, operating expense, and where's the money going to come from to cover my losses. Being able to explain those drivers, not to the nth degree, but it's kind of like the 80-20 rule. Chances are 20% of the drivers are going to move 80% of those numbers.
Yep.
So don't go crazy. All right. So now we got ourselves a plan. Where do I go for money? How do I know how much I need? How many tranches? What do I call it? Is it a Series A?
Yeah.
Is it an X? Is it a seed?
I think
what's the importance of all that?
You just walk down A, B, C, gets you free cash flow. You add up your free cash flow. It tells you how much money you need. The next thing is to know when you need that money, right? What's your runway look like, or your cash burn? When are you going to run out of money? And as a general rule of thumb, how much money should you raise at different points? Like when you're going to run out of money, the about 18-month category, 12 to 18-month category, or you want to be a little more, 12 to 20 months. That's how much money you want to raise. If you raise more than that, you're probably over diluting current holders. If you raise less than that, you're only going to be like raising money for the rest of your your known lifetime. Going through the whole raise process for any new CEO is going to be overwhelming, right? And the last thing you want to do once you close that round is start the process again. But usually that's exactly what you have to do. At least that has to be your mindset as a venture-funded, growth-oriented startup. Job of the CEO, number one job, is to raise money.
Yeah. What's funny about this conversation is that it's very simple, right? You're really trying to keep it high level, understand a few of the moving pieces. And 80% of the people we speak with, like they don't know this stuff. But yet, after 2 years of running their own startup, having raised capital, they become experts in this, right? And so it's kind of funny sort of listening to you, because I'm sure half of our customers would be rolling their eyes listening to you right now. But this is how the average startup really starts up, unless it's like not your first rodeo. But for most people who, this is their first rodeo, and they're from a technical background, a biz dev background, a marketing background, or even a finance background. I didn't know half of this crap like 8 years ago. This is very idiosyncratic to this market. And so it is actually pretty damn simple. There really isn't a whole lot to it, but there's nuances, right? Let's talk about valuation caps. So it happens to be one of our big SEO keywords. We have a lot of traffic that comes to GrowthLabFinancial.com through Google, through Bing, looking up what is a valuation cap. how important is valuation cap? I'm a startup.
Mhm.
I raise some friends and family. I book 250, maybe $500,000 in my bank. Do I care
Yeah.
about valuation caps?
Definitely do. You need to care about valuation caps, and valuation caps come into play with safes and convertible notes, right? One is knowing your plan. Two, knowing how much money you need. When do you need that money? And then figure out how are you going to raise that money, because it's not just like give me money and we'll just call
Yeah,
it
but
even.
if my rich uncle's gonna like cut me a $500,000 check
Totally.
or 100,000, that is this something I want to get into with him? Like, is this $1 million cap or a $10 million cap?
Yeah. So the valuation of your business determines like how much they're going to buy, like Shark Tank, right? Style. I'm going to give you X number of dollars for 25% of the company. That sets your valuation, right? And that's when you're selling equity, right? You're just selling a piece of the company, right? You're defining what is the total value of the company. I'm selling you a piece of the company. Caps come into play with safes and convertible notes, because you're not actually selling a piece of the company yet, right? You're in terms of convertible notes, you're saying you're giving me debt. I'm going to hold it on my books as debt, and when I raise money down the road, that sets the valuation of the company. Then you're going to convert that debt into equity at that point, at that valuation. And the valuation cap is a way for the investor in convertible notes framework, the note holder, to make sure that they're not getting over diluted. Because if you set a valuation cap at $10 million in a convertible note and you raise money at, let's say, $20 million, that debt instrument, all that money will convert in at $10 million. So they will, for a dollar basis, that old money or older money that's already invested in the company is going to get a bigger piece of the pie than the new money.
So you sort of defined it as a protection for existing investors. But what about for the founder? Like, should the founder just fold and say, you want a $2 million cap? Fine. But how do you justify a $10 million cap?
It's the balance. It's the dance, right? Founders don't want caps at all. Existing holders don't want a valuation cap, period. It is not in their best interest. They just want to be at par with everybody participating in the next round.
Mm-hmm.
So it is for the note holders as a hedge for them to protect against the founders going out and raising money at too big of a valuation.
And so, at what point do valuation caps increase prior to an actual equity raise?
Yeah, two things. One, you don't want to get too much in a convertible note or a safe or a series of them before actually converting them, because you can get a little lopsided, right? Because when you have, let's say, $5 million in convertible notes, and you're going out to raise $2 million, and that 2 million converts to 5 million, that's a little out of balance. What you want is to have, let's say, 5 million in convertible notes, and you're going to go out and raise 10 or 15 million dollars to convert that $5 million. The new money is not being dwarfed by the existing investment.
So, can you walk us through that example one more time?
I don't want companies to raise too much on convertible notes or safes because they can get unbalanced with the new money coming in. Because convertible notes, you use them for two reasons. One, convertible notes and safes, you use them because they're easier to transact. They cost less legal dollars, and you push the valuation date out. So it's tempting for companies to just live off of the convertible note or the safe, right, for a while. Start off with a $500,000 convertible note. We kind of burn through that money. We didn't get quite the milestones we want, or we see opportunity down the road, or we didn't land that big customer. So we want to bring in some more from existing investors, do another $500,000, right? So now we got $1 million in convertible notes, and we burn through that. And, COVID hits. And so, we're delayed, right? For good reasons that we can make an argument for. So we bring in another $1 million. We got $2 million in notes now. And now we're kind of at the end of that runway, and we want to raise some more capital. So we want to go out and raise a price round. And if that price round,
why do we want a price round? Why not more convertibles?
So let's say you brought in some more convertible notes, to the point, to go back to mirror the prior example. You had $5 million in convertible notes and safes, right? That's money that's already spent. pretty much, once you get to the place where you're raising more capital, right? So that money's already spent. It's not there, right? And you need to bring in more money to grow and to hit your next milestone. If you are bringing in, less than, I'll say, 2x what's in convertible notes, you're going to be a little bit out of balance. It's going to be a little harder to find that investor that's willing to protect the note holders, right? Because basically, you come in with another $5 million, you're basically saying, I'm putting new money in the door, and I'm protecting all of these existing investors because that money's already spent. They have nothing they don't have a bucket to piss in, right? So the new money coming in is filling up the bucket, and they're protecting everybody. If that money runs out and the company can't go anywhere, their money's gone too. They don't want that to happen. They'd be more likely to put that $5 million in if there was only, let's say, $2 million of notes. It's less out of balance.
But couldn't the $5 million come in at a higher valuation cap than the previous $2 million?
It definitely could. And if you're doing that series of notes, I want to see an increase in that valuation cap over time. Let's say you start with a $5 million valuation cap, raise the first $500,000, raise that to $7 million, $10 million, so that you tell a story. I'm keep bringing money in, but I am increasing my valuation so that when you do go out there to raise that price round, you are going out there at a, let's say in this example, maybe a $20 or $30 million valuation to bring that $5 million in.
Got it. So that's a valuation cap.
That's a valuation cap, and the kind of the some of the nuances of safes and convertible notes. Safes is really put on equity section of the balance sheet, convertible notes in the debt section of the balance sheet. Generally, they operate similarly, but convertible notes do earn interest. So historically, it's been a little bit of East Coast, West Coast. East Coast has been convertible notes. West Coast has been safes because safes originally came out of Y Combinator and a very standard document. So they're relatively cheap legally to produce because they're fairly standard documents, and investors know what they're getting into.
Good. All right. So that's financing for startups. Obviously, we could spend days talking about financing for startups and raising capital, but it's a little bit of sort of flavor, maybe a little vanilla, but flavor of what's out there. I think what's important is learning the nomenclature. There's a lot of nuances. I think it's important to at least know what people are talking about
and how it impacts your cap table.
How it impacts your cap table. Unfortunately, that's important if you're successful. If you're not successful and you need to take another bite at the apple to fill the bucket, how important is the cap table?
So I'd say it's still important, right? Yes, it's you don't need to spend time making sure you have a detailed cap table unless and until it's necessary, right? And to your point, but as a founder, you should stay close with your cap table because one of your best options, if you're running out of money and you really believe in this, you're going to try and do a secondary and sell some of your stock, right? So that you're not diluting anybody else around the table, because that's why other people might not want to bring in new money, is like getting diluted, right? But if you really believe in this, I've seen some of our customers do this, and it's painful to see, right? That's hard-earned equity, but they do sell a piece of that to get to the next milestone.
Business. And what about the use of a down round?
So down rounds, a down round by definition is I'm going to raise money at a lower valuation than I raised money last time. More often, you will see companies try to do a bridge and use a note or a safe to not have a down round, but essentially you are having a down round, even if the downside of that is in the valuation cap of the note. But you hit hard times. You're having a hard time arguing for an increase in the valuation of the business, and you have to have a decrease in the valuation of the business to raise capital. The biggest thing there is if your investors, lawyers were good, you're probably going to trigger some anti-dilution triggers in those documents, meaning, yes, you can sell equity at a lower valuation, but the valuation or the investor money that came in previously, they're going to get issued extra stock as if they were invested at that lower dollar amount.
Got it. All right. So maybe next week we can touch on some of the other strategies, such as how much to raise, when to raise, how dilution and valuations play into your capital raising strategy.
Definitely.
Great. And so that's coming to the end. Let's keep an eye on our teams. Let's focus on retention. Let's get acquisition more intentional. Let's be a little less passive. And maybe next week we talk a little bit about leadership and what it means. And then back to basics with Startup Financing 102.
Sounds good. Thanks for tuning in. Catch you next week.
All right. That's this week's The Raw Take.
Thanks for joining us here on The Raw Take by GrowthLab. We are passionate about the finance as a service space and helping our customers and our industry overcome challenges and take advantage of opportunities.
Yeah, that was fun, Steve. Appreciate it. See everyone next week.